Hi everybody, Mohnish Pabrai is making a big bet on a sector most investors left for dead, offshore drilling. He just bought into two companies, Valaris and Noble. The question is why, and could that be a smart place to park some cash? And yes, it is another Pabrai clone from Launch Investing. At this point, are you even surprised? Over the next few minutes, and I will keep it tight, my YouTube stats tell me that is all I get, and a special shout out to the 100% male audience. You guys are a statistical anomaly. I am going to walk you through the simple, powerful bull case for these companies. We will cover what they do, how you could make money, and the huge risk that has been keeping me from going all in just yet. As always, this is just for entertainment, so let's get started. So what do these companies actually do? In simple terms, Valaris and Noble are giant landlords for the deep sea. They own and operate massive, high-tech drilling rigs. Think floating platforms the size of football fields, and rent them out to big oil companies like Shell and Occidental. They get paid a massive daily fee called a day rate, which can even be $500,000 or more, just for making the rig and its expert crew available. And here is the key part. They aren't taking the risk of finding oil. They just provide the tools. They get paid whether their clients strike a gusher or drills a dry hole. It is a classic picks and shovels play on energy, and that is what makes it so interesting. Now that we understand what they do, let's look at the bull case. If we are cloning this idea, we need to answer two questions. How do we make money and how do we lose money? Let's start with the bull case. It comes down to three key points. First is the capital cycle. After bankruptcies and consolidation, only the strongest companies are left. These companies have come out with leaner fleets and healthier balance sheets after the bankruptcy, which for both Valaris and Noble was back in 2021. Second is the operating leverage. Think of it like this. It costs a ton of money just to keep these rigs staffed and floating. But once the day rate they charge covers those fixed costs, almost every extra dollar they earn drops straight to the bottom line. It is like a rocket ship for profits, and right now day rates are taking off. Finally, the third point is the asymmetric payoff. At current day rates of roughly $500,000 per day, both Valaris and Noble could generate over $1 billion in free cash flow annually. The enterprise value of these companies are roughly $4 billion for Valaris and $6 billion for Noble. So we are looking at free cash flow yields of 25% and 17% on the low end. It is an insane return, and managements plan to use that cash cannon to buy back their own shares. As the number of shares goes down, your slice of the pie gets bigger day after day. Now, let's look at an overview of the offshore drilling sector. Offshore drilling provides roughly 27% of global oil production. It uses rigs that are either floaters for deep water or jackups, which rests on the seabed. After the 2014 oil price collapse and the shale boom, the industry went through a brutal contraction. Lots of older rigs were scrapped. The global count of the premium 7th generation floaters has basically been halved since the last upcycle. So you have tight supply and rising demand. What happens? Day rates have exploded. They have gone from just break-even to multi-year highs. And for these companies, that means a fire hose of free cash flow. Plus, new rigs cost over $1 billion and take years to build. So no one is building them. Okay, let's focus on the companies, starting with Valaris. Valaris emerged from bankruptcy in April 2021 with almost no debt. Today, it operates 49 rigs. They have locked in 99% of their 2025 contract days, giving them a backlog of about $4.2 billion. Management has made capital return its top priority, using all free cash flow for share buybacks. At current day rates, Valaris could produce about $1.2 billion in free cash flow per year. Over 5 years, that is enough cash to theoretically buy back every single one of their shares. Now look, that is an optimistic scenario, but it shows you the scale of the potential asymmetry here. Even a more realistic case could see massive returns. Okay, now let's focus on Noble. They have grown through acquisitions to become the world's largest drill ship owner. Noble markets 40 rigs and has a massive $7.5 billion backlog. So what is the trade-off? With Noble, you get a bigger scale and more exposure to this deep water upcycle, but you are also taking on more debt and the risk that they stumble trying to manage their larger, more complex business. Higher potential reward, but definitely higher risk too. Okay, now with all that said, we need to focus on the main risks. And let's start with the big one. The one that changes the entire equation, the energy transition risk. Now, this isn't just about a slow, predictable shift to solar panels and wind turbines. The real existential threat to this entire thesis is the arrival of near-free and near-abundant energy. And the catalyst that could make that happen far sooner than anyone expects is artificial intelligence. The transitions of the past from wood to coal or coal to oil took decades. We could see them coming, but this time is different. The exponential progress in AI is a wild card. AI is not just for writing emails or making images. It is being deployed to solve the most complex problems in material science and physics. We are talking about AI models that can can discover new materials for hyper-efficient batteries, optimize energy grids in real time, and this is the holy grail, crack the code to commercial nuclear fission. Think about the immense energy demand that AI itself is creating. Data centers are projected to consume as much electricity as entire countries. This creates an unprecedented economic incentive to find a breakthrough energy source. So we are in a strange feedback loop. AI needs more energy, and so AI is being used to accelerate the discovery of that new energy source. If someone achieves a net positive energy from fusion that is commercially viable, the value of oil and gas reserves changes overnight. The question is not if this will happen, but when. And AI makes the when terrifyingly unpredictable. This is the central tension of the investment. Valaris and Noble are in a race to monetize their assets and return cash to shareholders before they become obsolete. It is a golden parachute, but the question is if they will have time to deploy it. If the world of abundant, almost free energy comes a decade or more down the road, this investment has the potential to be even 100 bagger. You just collect the cash from a dying but still very profitable industry. But if an AI-driven breakthrough makes fusion viable in the next year or so, this investment will be a terrible one. And this is the main reason why I don't yet have a position in these companies. The risk is no longer a distant, abstract concept. With the current pace of AI development, it is a very real, near-term possibility. I will likely initiate a position, but this risk is as real as it comes. So now let's talk about the other, more conventional risks. First is demand shock. A global recession could crush oil demand and the day rates. The good news is both Valaris and Noble have multi-year contracts that give them a cash flow bridge for at least 2 to 3 years. Then there is the new build risk. A sudden wave of new rig orders could flood the market. But again, with the new rigs costing over $1 billion, long lead times and ESG pressure, a near-term oversupply is highly unlikely. And finally, like in other company, there is the execution risk. So there is a lot to track here. Day rates, the risk of recession, and that big energy transition question. If you want to see how I am monitoring these factors in real time, get my deeper analysis on these thrillers, and see my other Pabrai-inspired bets like Raysash and Hava Airports, please consider checking out my Patreon. You get access to all my past and future work, and my results are speaking for themselves. The link is in the description. Okay, with that said, let's talk about valuation and the payoff potential. Valaris currently trades at an enterprise value of roughly $4 billion. Noble trades at about $6 billion. If their rates stay where they are, each company could generate enough free cash flow over the next 5 years to buy back at least half of their own shares, even assuming the stock price rises significantly. That mechanical share count reduction alone drives your per share value higher and higher. In a more bullish scenario, where day rates rise to $700,000 or $800,000, the cumulative free cash flow could exceed their entire current enterprise values. That is the multi-bagger potential I mentioned earlier. On the downside, contract backlogs and the value of the asset itself provide a partial floor to the share prices. Okay, that basically wraps up the deep dive on Valaris and Noble. These companies represent a classic cyclical opportunity: lean balance sheets, high operating leverage, and an asymmetric payoff profile through buybacks. If you found this analysis helpful, please like this video, subscribe to the channel, and click the notification bell so you don't miss future deep dives. In the comments below, let me know which risk or upside you found most compelling. Thanks for watching, and I'll see you in the next one. Bye.